Hey, good morning. Dean Hartman here. Second video of the year. So this one I want to put a little bit of mortgage stuff in and then end with a little bit of life stuff. So on the mortgage front, I just want the public to start being aware that the pendulum has started to swing back. For a good part of the early part of this millennium, mortgage guidelines got too loose. We created a housing bubble, things crashed, and as typical, the government got involved and guidelines got too tight. A whole bunch of things with Dodd-Frank got involved and made it harder and harder to get a mortgage. And as human nature will want to be, we need more mortgage product. We need more people to be able to buy houses and start using some common sense. So the pendulum has started to swing back. It's not back to crazy, but it could get there not too soon into the future. I just want you to be aware that there are options. The biggest part of Dodd-Frank that affected borrowers was what's called the ability to repay rule. And with that rule, we could only lend money to people who could prove they could pay it back. Common sense says that makes sense. But that really put a ding into the self-employed borrower who is, on one hand, trying to write off a lot of expenses and minimize their taxes to the government, and on the other hand, wants to buy nice things. So there were plenty of self-employed people that probably were making six figures in income, but showing the government that they made in the $25,000 a year range. That put them out of the mortgage market for a significant period of time. What some investors have started to do is look for other ways to prove that that borrower has the ability to repay the loan. So one of the programs that is becoming more and more popular is what we call the bank statement program, where we will look at the actual deposits that that self-employed borrower makes into their bank account every month. So let's say a restaurant owner puts $100,000 into the bank because they're swiping credit cards left and right. They might have told the IRS they made $1.50 that month, but they put $100,000 into their deposits. We'll qualify them as if they made $50,000 that month in income. So we'll take 50% of the deposits that a self-employed borrower is making and treat that as their income. So that restaurant owner who might show $25,000 a year in income on their tax returns may qualify as if they were making hundreds of thousands of dollars based on the deposits into their bank. Some businesses will even go over 50%. Some of these people, because now it's a full income check loan, could go as high as 90% up into the $2 million range in a loan amount. So there's a lot more product available for these borrowers, and it's FICO driven, it's, the credit's important, the tracking the assets, all that other stuff is important. But lenders are starting to use alternative methods to qualify the self-employed borrower. And you should be talking to your mortgage professional to make sure that if you're a consumer, that you thought you couldn't get a loan, maybe you could. And if you're a real estate professional, that some of the clients you've shied away from should be back in play. And, reach out to us. Let's talk about it. Now, on the life side, one of my favorite, not my favorite band, is Rush. One of the reasons Rush is my favorite band is not just the musicianship and the talent of the three players, but also the lyrics, largely written by Neil Peart. And one of my favorite lines from Neil Peart in the song is, "You can fight without ever winning, but never really win without a fight." I love that idea, right? That you can always fight and you could lose, but nothing worth winning doesn't come without a struggle, doesn't come without a fight. Because if it's worth winning, other people want it too, and you're going to have to compete. And life is about competing, of course fairly and ethically, but competing to win. And hopefully, as the year starts, you have a plan to compete and compete to win. So that's it for today. Talk to you later in the week.